going to open with a few definitions. So question number one is, what does it mean to place a life policy in trust? And we're going to start with Vincent on this question.
Okay, I think, Tabby, obviously we've probably got a range of different experiences on the webinar session today, but I think if you think about it from its most basic sense, if you buy anything at all, you know, forget life insurance policies, but if you buy things, that usually there's a question of who is this intended for. And of course, if we think about what we're talking about today, life insurance policies, and especially single life policies, there's no value in the main benefit of the policy until the life assured dies. That's when it turns into money. So for life policies not written into trust, the beneficiary of the policy is the owner of the policy, which is weird, isn't it? Because how can that person benefit when they're dead? Can't do that. So the purpose of a trust, I would say in its most simplest and basic sense, is to create a mechanism to pay the proceeds from the life insurance policy when the life assured dies to the beneficiaries. So simple as that. And of course, trusts do loads more than that, but in its most basic sense, it's to deliver the money to the right people.
Yeah. Do you agree with that, Mark?
Yeah. So Vincent, you know, I always explain it in this way. You know, the only reason that you're buying life cover is because you know who you want to benefit when you die. So you know. So tell us who that is. Tell us who that is when you take the plan out. The simplest way of doing that is to set up a trust or beneficiary nomination. And that comes with some great advantages because it pays out the right money to the right people at the right time. It avoids probate delays. It avoids intestacy delays. And it's also inheritance tax efficient. So, you know, that's why we'd always encourage people to use a trust. And I don't know if you've got anything further to add, Vincent?
Yeah, I mean, those are some of the extra benefits, aren't they? You know, we for more wealthy customers, they could be thinking about tax problems and implications. There's loads of layers. I think if you think about the history of trusts, they go back hundreds and hundreds of years in England. You know, back to the time of, if you're a history buff, back to the time of the Crusades, go back a long time. So I guess if you think about that, with that sort of history and legacy behind it, there's going to be layers of complexity. But I'd go back to you know, if you think about your own self, if you've got life insurance policy, you'd use a trust in its most simplest form to make sure the right person gets the money, because without it, there's a chance that won't happen. And that's kind of the situation we're in at the moment, where, you know, certainly in the non-advice space, people take policies and there is that question mark, is the right person going to get the money? So, you know, the best mechanism we've had up until now has been a trust to achieve a good outcome there. Obviously, I think we're going to get into something that you mentioned just there, Mark, which is potentially a plan B, an alternative to a trust.
Yeah, delving into that plan B, what's the difference between a trust and a beneficiary nomination? If we start with you, Ruth.
Well, with a trust, it's sort of separate to the policy. Beneficiary nomination is included in the policy. So with beneficiary nomination, you are saying to the insurer who they have to pay. And when I say have to pay, they literally do have to pay who you've told them. So it's not something that is discretionary for the insurer to think, oh, is that still relevant at the time? You, the customer, say who it is, and that's who the insurer pays. So within that, of course, life changes, and the terms of the policy, which dictates the rules for beneficiary nomination, a bit like joint life, actually. Joint life also is a way of saying who gets the money, but it's not flexible. You both take out the policy, you both own it, and whoever survives, the policy says, well, you get the money. Same with beneficiary nomination, is the policy says who gets the money, but within the terms of beneficiary nomination, flexibility is given. So the rules of the policy say, well, if your life changes, if you've split from your partner, for example, you, the policyholder, have the ability to update us and tell us, well, who should it be now? With a trust, it's somewhat different. The trust is a separate legal agreement. So within that, you have, as Vincent alluded to, you have some layers of complexity. And one of those complexities is that not only do you have to say who your beneficiaries, you also have to say who are your trustees. So you are a trustee, but you also need to pick who are the people, or maybe just one person, who you really trust to sort things out after your death. You might actually pick the same person as your beneficiary. It might be just pick your hubby, because you think, oh, well, it's simple. I just want him to have the money. He's the one who's going to be able, as trustee, also to tell the insurer, right, I'm the trustee, pay it to me, and happy days, because I wanted the money anyway. But if it's more complicated than that, you may have it that the trustee is there, or the trustees are there to decide, maybe in a more complex family situation, who gets the money at the time. And it could be for a range of children, for example, same family or maybe mixed families. And in that case, with a trust, you've got the trustee who survives gets the job of deciding, right, okay, let's see where everybody is now. How should we split up the money? And I'll divvy it out using my discretion. So that's, I hope, a run through of what the differences might be.
Thanks, Ruth. Ron, do you have anything to add to?
Firstly, thanks to Vincent and to Mark, in particular for the history lesson. Just a note of comfort for people listening on the call that I think the words have improved a bit since the Crusades, and they're a little bit easier to follow. So there's some comfort in that. It's useful as well, I think, to hear Ruth speaking very clearly about the distinctions between using a trust and using beneficiary nomination. Just really to add that there are different types of trust. For the most part, they are discretionary trusts that are being used. It is possible to have an absolute trust or a bare trust. And thinking about it as Ruth was speaking, I was thinking that feels much closer to beneficiary nomination, but it's far less common because it doesn't retain the flexibility. You know, the beneficiary is stated and can't be changed. So I think it's relatively rare these days to use an absolute trust, just because of the uncertainty of well, life changes, doesn't it? And I think it's the discretionary trust does address that well.
No, definitely. Speaking on trusts and other directions, letters of wishes, and how does it A, simplify direction of benefit of trusts, and B, compared to beneficiary nomination? Vincent, could we start with you on this?
Obviously, with beneficiary nomination, if we think about what Ruth was saying there, when you take a life insurance policy, and as part of that process to apply for the policy, you name the beneficiaries. You know, you've named them. They're part of the contract, and of course, you've got the ability to change that later on down the line. With a trust, and something I've been sort of campaigning about for quite a long time, really, is it just seems weird to me that if you take a life policy and you write it into a trust, and you pick people that you trust to actually do the right thing when the time comes. So it's their responsibility to collect the money from the life policy and to pay it on to the appropriate beneficiaries. Wouldn't it be a good idea if you told them what you wanted them to do? And of course, you know, if you look at all the different life policy trusts from the life providers, they come in different shapes and sizes. Some of them, you know, I'd say most of them don't really allow you to articulate what your wishes are. I've not really seen that. I think there's one life provider with a box with a bit of free text in it, but there's not many. So a letter of wishes, basically, it's just my instruction as the person who takes the life policy, the settler. You know, I create the trust, I write my life policy into it. And of course, because the trustees have got nothing to do until I've died, that contains the letter of wishes contains my instructions about what they should do when the time comes. When you think about it in those terms, it's so logical that we should do it, but the industry doesn't do it. You know, this is something where we need to get better. All it really needs to be is a simple Word document that's written to each of the trustees, and it says, this is what we want you to do. If there's you know, some circumstances, so for example, when you get married, or when you reach a certain age, or you know, you can put that kind of detail into the letter of wishes, and of course you can update it as many times as you want to. It's a guideline for the trustees to do the right thing when the time comes. It's not legally binding. They don't have to do what it says in the letter, but if you pick people that you trust will do the right thing, it's just fair that you actually, you know, explain what you want them to actually do. We'd always say that one of those letters to each of the trustees, it should be signed and dated by the settler. Otherwise they should ignore it, because it could have been written by anybody. And I would say also it'd be good to have a little line at the bottom that simply says, ignore any other letters of wishes dated before this one, because you could update it umpteen times. The one you should pay attention to is the most recent one. And that's basically it. So it doesn't really form part of beneficiary nomination, because that's baked into the cake when you do the application. This is really to do with the trust, and it's an additional component.
And it's not widely recognised in the industry currently.
Not really, no. It's not. When I speak to advisors about it, it's not something that is commonly done. I guess one of the problems with it, and maybe for all advisors listening to this webinar today, if you just think about it, that whose responsibility is it to do one of those? It's really not the advisor's job. But when you actually do a demands and needs letter, and you know, typically we put something at the bottom that says, I recommend that you actually take out a will. You know, how many people actually do that? Some people do, but I guess most people don't. We need to hold their hand and facilitate it. This is a letter from the settler to the trustees. That's the relationship there. But advisors, I think, can get in the middle of that and just and facilitate that journey. The letter doesn't need to be elaborate. It only needs to be a couple of lines that explains what needs to happen.
So you feel like advisors, when consumers are coming in after they've had a mortgage or they've had a child, to kind of encourage an update of a letter of wishes?
Yeah, it's a good idea to always look at it. Just look at it, see what it says. If it's not right, change it. If it is, leave it where it is. But certainly there should be some level of instruction. I think when you review any kind of trust, I think you should look at the trust and say, okay, is this going to deliver the outcome the customer wants? Is there anything that could go wrong here? And, you know, if it's just the trust form, you know, which is very commendable, you write the life policy into trust, very commendable to do that. But of course, if it's a discretionary trust, then there's limits as to what the trustees can actually do. They've got to do what it says within the confines of that form. So, you know, is it fit for purpose? I think one of the big areas, I think we might get onto it, is unmarried, because they're never listed. So, you know, a lot of unmarried, you know, couples out there that take life insurance policies. So is it going to deliver a good outcome? You know, a letter of wishes can facilitate that.
It's almost safeguarding it, giving it a personal safeguard. Mark, what do you think about the letter of best wishes?
Well, it's, you know, to recap what Vincent and Ruth have already said, actually, beneficiary nomination actually is an instruction to the insurer to the beneficiaries as nominated. But if there's a death, we pay what's on the beneficiary nomination. With a discretionary trust, we pay the trustees. And then it's up to the trustees to decide who to pay. Do they pay the people named in the discretionary trust beneficiary box? Or should they change it to another class of beneficiary that is a potential beneficiary that's been named? And, you know, that's up to the trustees to decide, because the life assured's dead. And so that's why it's so important to pick the right trustees. Now, Vincent, you know, very articulated very well that to help your trustees, you can write a letter of wishes. And this should be used to really highlight changing situations. So, you know, you might have an ex-wife with young children. You might say, whilst those children are under 21, pay my ex-wife. But once they're over 21, pay my new wife. You might say, don't pay my children until they're over 25. You might say, if somebody's dead at the time, what to do? Do you bypass them and give it to their children or their grandchildren? So, you know, letter of wishes gives great flexibility, and it's really simple to do. So this is the important thing. It's simple. You just write a letter to your trustees saying, you know, today this is what I want to happen, but tomorrow my circumstances might change, and if they do, here they are listed out. Please follow those instructions. But it's really important that you trust your trustees, because this is guidance. They can ignore your letter of wishes, and they can ignore who you've listed as the current beneficiaries on the trust form and pick somebody else as a potential beneficiary. So make sure you don't pick a brother-in-law that you don't really know that well, and maybe the marriage is a bit rocky, because if they split up, this estranged trustee is going to be hard to contact and may not really be engaged in following your wishes. So always pick someone that you know, a lifelong friend, a family member that you absolutely trust to carry out your wishes. I see a question pop up. Where do we suggest a letter of wishes is kept? Well, you could. Now this really depends actually, because you know, some trusts are paper, some trusts are electronic, and I think you know, if it's a paper trust that the settler's completed, just you know, flip it to the current trust. If it's an electronic trust, I would suggest that you send it to the provider, or you know, your life company, because we will store it with a copy of our electronic trust, and then if there's a death, we'll have that on record. That's in addition to giving it to your trustee. So you can get, you know, because we'll always say, well, here's the trust, here's the latest letter of wishes. So these are the instructions we've got. We can give those back to the trustees. The trustees can then check if they've got anything dated later, and if not, you know, they'll go with the latest instruction.
I'd just add on to that, Mark. If you think about if you're giving financial advice for the life policy and write it into a trust, and then letter of wishes, you know, the advisor should have a copy of it. The trustees should all have a copy of it. The customer should have a copy of it. The settler. Make sure there's lots of copies of it. So you know that we know that in life people lose things.
Yeah.
And of course, that if you've got it as the advisor, you can review that next time round as well. So as many people as possible. It's all the relevant players really, but essentially it's the trustees. It's the letter to them to tell them what to do.
No, definitely.
I think this is a really important area to be looking at, and particularly as the impact of all of this is felt at what we often refer to as the moment of truth, i.e. when a claim occurs. And I was just thinking across to the group life market, where I do quite a bit of work, and the challenges that employers can sometimes face, because there the group life policies are set up under a discretionary trust. So most payments get paid quickly. But there is always this difficulty of how do you cope with complicated lives that people lead these days? For all the sort of examples that Mark and Vincent were giving. And the employer may not necessarily know about this, so it can present some very, very difficult situations for the trustee at the point of claim. And a result of that can be that there's a delay in paying the claim, because the trustee, in discharging his liabilities responsibly, will always want to make sure that they meet their expectation of the best endeavours of the deceased. And that's not easy, but there can be quite difficult cases to deal with. You know, there may be children that nobody knew existed suddenly appear, things like that, and it's complex. So I just think this is so important to consider.
Do you have any thoughts? before we move on?
Did you ask me? I didn't hear.
Yeah, sorry, I asked if you had any extra thoughts before we move on.
I'm ready to move on.
You're ready to move on? Okay, right. Well, we're talking about complicated lives. We're going to delve into one of those elements. Earlier this year, research conducted by Scottish Widows found that only 52% of unmarried adults who are in relationships know whether their partner has a life policy, which demographics are at risk of losing out of a life insurance payout if direction of benefit isn't established.
I'm happy to jump straight in with that one because we've got a clue in the question. So here we go. This is the big elephant in the room for life cover as far as I'm concerned, because it's unmarried couples. Surprise! Unmarried couples are the ones who are totally exposed here. If nothing is done to direct the proceeds of life cover that is meant for them, they may not realise, in fact, a lot of people don't realise that if nothing is done, then the law takes over, and that's the intestacy rules, which basically say, well, it's the next of kin who get the money, which unfortunately, despite people thinking, oh, common law wife, common law husband, that's a thing, isn't it? No, it's not. When it comes to the law, if you die without directing the proceeds, whether it's with beneficiary nomination in the contract or by putting it into trust, or as your backstop as a will, although that can be challenged in some circumstances. If you don't do any of that, then your unmarried partner won't get the money, unless they are one of the very lucky ones where maybe your mum and dad really appreciated your now bereaved partner and are kind enough to actually hand the money over to them. But that's totally dependent on goodwill from the family. And too often, there are cases that various of us on this call are aware of where that kindness has not come into play. Parents get the money, or it could be other relatives. It doesn't matter who the relative is. They've got rights over that money that the cohabiting partner, who may have taken out the mortgage with you, may even have been funding the policy effectively out of the joint account, doesn't help. It's their money gone. That's the answer to that one.
I would just add on top of that, Ruth, that if you look at the offerings that we've got at the moment from all the different life insurance companies, obviously there's different ways of actually facilitating the creation of a trust, and the electronic ones are the simplest. So some of those happen at point of sale. Great. So you can actually write your policy into trust when you take out your life policy, it sounds like a really good outcome. But when you just pick away at that a little bit more, how many life offices at the moment actually accommodate unmarried partners in the list of discretionary beneficiaries? I don't think there is any at the moment. So it could be that you're sat there as an advisor on this call today, writing life policies, recommending that they go into a trust. If your customers are unmarried, they're going to need to do something else. Because if that unmarried partner isn't listed, legally they can't have the money. The trustees don't have the power to award it to them, and that's a problem.
Yeah, I mean, some life offices, Vince, so Guardian, do have a box where you can add a partner. So with a Guardian trust, you could add their name in. But, what it doesn't facilitate is that if you're young and you take your life policy out and you write it in trust and you end up with a new partner, then that's not catered for. So this is prompted some thought in me, actually, Vince, how do we achieve that? So I'll be
yeah, it reminds me of that Michael Bublé song, you know, I just haven't met you yet. What if you haven't met the person yet? What if you haven't met them? That won't be on the trust form, and it won't be a discretionary beneficiary as part of the standard wording. So you're going to have to do something, and if you don't, then it's going to be a problem if a claim comes in.
Yeah, and I think this is a problem for all advisors if you don't recommend a trust. I've seen, as we've alluded to, I've seen instances of people buying their own home with their partner, shared bills, shared bank accounts. One of them unexpectedly dies, and your mother-in-law's got all of the money to pay off the mortgage, and they've kept it. And I've seen people lose their home, and so you know it's a really, you know, you can't emphasize how important it is. You've got to protect the clients.
I think this is a really important part of this whole session today. And as Ruth said, kind of the answer as to who's vulnerable, it was kind of in the question. And it's just useful, I think, to sort of look back at market data and population data. Quoting from ONS data in 2021, 27.6% of all couples living together and under 65 were cohabitees. Now that had gone up over a 20-year period from 18.5%. So in rough terms, it's increased by 50% of what I guess would be a higher number of people in the first place, because population's been increasing. And also to go alongside that and to reinforce, the percentage of single life policies is increasing, and the percentage of joint life policies is reducing. In itself, personally, I think that's a good thing, but it does have obviously implications. But for level term policies, it's around about 90%, and now level term policies, it's now around 90% of all policies are single life, and that includes those with CI, critical illness cover. It's a little bit different for decreasing term policies, most generally taken out to cover a mortgage. But I think the data there just reinforce the importance of this whole area, because advisors will be dealing with people in these circumstances pretty much every day of the week, I guess.
No, definitely.
So, having said, oh, this is a massive problem, which, yes, it is. Anybody on this call thinking, oh, what am I supposed to do then? There is light at the end of that tunnel, in the sense that, and I would put Guardian first of the list here, because top of mind. Many companies helpfully ensure that you definitely have got the cohabitee covered on day one. And how do they do that? Well, they insist that you actually say in the trust form, who is your default beneficiary? Who is the person right now, all things being fine as it is today, who do you want? And by forcing that, all those couples that take this out together for a mortgage will have that person named in the trust. So that's fine. They are covered, and it sets you off on the right foot. The second thing is also, you know, Guardian, I mean, commonly across the market, the option, I should say, commonly across the market, others do get the default beneficiary, and however, some try and save you time by not insisting that you put a default beneficiary there. If they offer you the option, what I'd recommend is you definitely use that box to day one, say who it is. If that doesn't exist, your other option is to make sure you have put their name on the list, because all trusts that are discretionary across the market do offer the space to add another person among the class of potential beneficiaries. So yes, this thought needs to join up with where I was going just a moment ago. that's fine on day one, but later, as Mark has said, you may have a new partner come into your life. What about them? So it would be worth all of us checking how the particular life trust is written, but often that option to add any other class of potential beneficiary leaves the door open for you to add somebody in at a later date. So the terms do allow for it. You just have to know about it, and you have to have a prompt. And who else can be the prompt but the advisor, hoping that you're keeping in touch with your clients. But hidden in the fine text is that opportunity at a later date to nominate to the trustees, and it will say something along the lines of this last class, a potential beneficiary can be somebody that the settlor policyholder who set up the trust, they can nominate somebody else to the trustees. So it includes anyone else that the settlor states to the trustee and picks as a beneficiary. So you do have options for solving it in all these different scenarios, but you need to be aware of it. And certainly your clients need to be aware of it, but they probably won't know. And this is where advisors can really make a huge difference.
No, definitely, thank you. Other than cohabitees, are there any other demographics that are at risk of missing out on a payout that we can think of?
Ruth, you're not, because that's the massive problem about cohabitees, but a lot of people also don't realise that if a will hasn't been written, so again, it's going through the intestacy rules. Even if you're married, doesn't mean you get all the money. So, and this varies across the different countries in the UK. So the amounts and the precise rules are different for Scotland versus England and Wales, and different again for Northern Ireland. But the same principle applies, is that the rules of intestacy dictate that, yes, the next of kin can get and does get quite a lot of the money that comes out of your estate, but not all of it. So there's a cap. And after that, if there are children in the relationship, then it gets divvied up between the children and the spouse. So although often it won't come into play, those caps actually haven't really kept pace with inflation very well, and there will be a lot of life policies written today that do exceed that. Once you add that into the rest of the value of the estate, assuming it's not all evened out by the mortgage debt, that could become very relevant. So the partner thought they were going to get the whole policy, but no, actually they've got to hand over part of that to their children.
Yeah, it's probably worth, as a sales opportunity, sales aid, if you like, just get the rules of intestacy for England, Wales, Scotland, Northern Ireland. They are all different, and the distribution might surprise you. It's worth having that in your kit bag so you can talk to customers about it.
No, definitely. Are there any other thoughts on affected demographics before we move on to the next question? I think we're safe. All right, let's move on to question 5. We've got the probate problem. According to Go Compare, there are currently 6 to 12-month probate delays for life policies that aren't written in trust. How and why can trusts and beneficiary nominations solve the probate problem? If we could start with Ruth, that'd be great.
Okay, well, I can add to that as well. It's a double whammy for the cases that are without the benefit of a will. So it's actually a much longer wait for cases where either there isn't a will at all, or wills where the executor that's been chosen either has died before the deceased, or just are not in a position or to act, or not willing to act. So those cases, the gap has really widened up over the last few years in how long those cases are taking to go. So it's definitely, you would hope it was a reducing problem. Actually, it's a problem that has grown over recent years. But the big brilliant news is, if you've done a trust and you've got surviving trustees, which is key, or if you've used beneficiary nomination, then that's not a headache you have to worry about at all, because probate just simply isn't necessary. The whole point of probate is it's a legal process to facilitate the transfer of ownership to the next place it needs to go, if that hasn't already happened. And therefore, a bit like joint life policies, we're all used, I hope, we're all used to the idea that if it's a joint life policy, the insurer can just immediately pay out to the survivor. That's what the policy says. You don't need probate. And the same applies with beneficiary nomination. You don't need probate to step in and say, where should the money go? Because that's already dealt with. And similarly with the trusts and the trustee, the wrinkle there, though, again, is if you don't have a current trustee either alive or able and willing to act, unfortunately, that boomerangs back into the probate trap, simply because it's the trustee who has the legal relationship with the insurer over the policy. There's only one policy that gets around that. I said policy, I meant trust. And guess whose it is? It is the brilliant guardian. So the guardian trust is the exception to the rule here, where it includes a term in the rules of the trust that enables guardian to pay directly to a beneficiary if for any reason they're not the trustee and the trustee doesn't exist or can't act. But the general rule, apart from that notable exception, is that if you've got no trustee at the time of death, the beneficiaries still have to wait to go through this probate process. And it's the probate process itself which allows the executors or administrators of the estate either to act and step in as trustees or to appoint other trustees.
Very interesting. Ron, do you have any further thoughts on the probate problem?
Yes, just briefly. I think Ruth has described the issue extremely well. And I think given those issues, this is an absolutely fundamental part of what an advisor should be putting together for their customer. We have to remember, and I did briefly allude to it before, that we are likely to be dealing with people who are both in emotional difficulties because of the loss of a loved one, but also may need the proceeds quickly. And now I know there are issues as well, and there's an opportunity to avoid IHT. For most people, that's not the case because most sums assured are well below the IHT limits, although IHT receipts are growing as a result of the freeze of the limits. So that becomes a bit of a bigger problem, but this about getting the money much quicker, I think is absolutely fundamental to what an advisor should do. And we've seen data, shared data before, on the take up of trusts. So by the market, it's increasing. It's not increasing fast enough. From my perspective, I know sometimes people say, well, why should I put it under trust? And some of that we're trying to get across clearly here. But in an advisor's shoes, I think I would be looking to say, build it into my system should be, why have I not put this into trust? Now, it may well be a slightly different question in that, why have I not sorted out policy ownership? So it could be joint life, it could be beneficiary nomination, but I think it should be 100% of cases that question should be asked. And and it's got all sorts of benefits as well. I think it improves the quality of the proposition that advisors have. And I think generally that is probably likely to flow through into improved business persistency as well. So I think while it's absolutely the right thing to do to make sure we get the money to customer quicker, it has positive benefits for the industry in terms of business retention. So I think this is a really fundamental question.
I'd just tag on to that thought as well. Thanks, Ron. The thought that another benefit to the advisory side of the industry is really to make them cast iron protected under the consumer duty when it comes to the responsibility for ensuring good customer outcomes. Because obviously, when it comes to life cover, getting the money to the right person, intended person, without whom the policy wasn't needed, that's got to be the number one good customer outcome. So to address that, have we dealt with ownership one way or the other? Seems to me essential, really, to for advisors to show that yes, our process has been set to ensure the right good customer outcome.
I totally agree with that, Ruth. I think we put a lot of effort, and quite rightly, into the underwriting process and the sales process at the beginning. But I do think that this has to be a absolutely 100% compulsory thing to be looking at outset. And if we look at the consumer duty and what it's trying to achieve, making sure the proceeds end up with the intended beneficiary seems a pretty fundamental way of dealing with this. And we're mainly, I think, talking about pure life assurance here, but clearly in some circumstances, the customer will have a life policy with a critical illness rider, and it's important to make sure that the CI benefit goes where that was intended to go, and the life cover goes where that was intended to go. And in many cases, they're going to be different. But I think it's just so important that we get these things sorted out at the outset. So well done, Ruth, for being the first to mention the consumer duty. Somebody had to. And I do think it's very, very important. And it's a message that at Swiss Re we are trying to get across to customers for many reasons that I've really just covered.
Thank you, Ron. We're going to shoot off to question 6 now. Last week, Royal London announced that it has extended its online signature-free trust process to its personal manual plans. This eliminates the need for an electronic or wet signature from clients or nominated trustees. Why is it important that insurers continue to simplify the process for placing policies in trust and nominating beneficiaries? Could we start with Mark on this one, please?
Yeah, thanks. So I think congratulations are due to Royal London for, moving forward with that. The COVID pandemic certainly did create some problems for life insurers when it came to how do you write plans in trust when people aren't allowed to be in the same room. So, it did push forward innovation. However, take-up of trusts is still far, far, far too low. I think we're looking at around 10%. That's 90% of cases that are not written in trust. But we know that it's the right thing. It's the best thing for customers to put a plan in trust. We've heard today the reasons. When somebody takes out a life plan, it's because they want somebody to benefit. If they don't tell us who they want to benefit by setting up a trust or a beneficiary nomination, the proceeds probably won't go to where they want it to. It won't be dispersed as they believe it will. You know, cohabiting, your partner may get nothing. So, you know, this is the one, you know, so why is it important? 10% is just not good enough. I think it's as simple as that. I mean, I don't know if Vincent might have a view on that one.
Well, just obviously we got some of these questions sent through. Your question there, Tabitha, was why is it important that insurers to continue to simplify the process for placing policies in trust and nominating beneficiaries? The answer is because it'll happen more. It will happen more if we simplify the process. When you alluded to that situation that we saw in we all call it lockdown, pandemic, COVID, that thing we had to live through for a couple of years. You know, one of those things I didn't know about was when you look at some of the trust deeds. So somebody needs to have their signature witnessed. What that actually means is the witness has to physically see the signature take place and not over Zoom in the same room. So this goes back hundreds of years. It goes back to the history of where we are with these things. So it'll simply happen more and more of the time. And the thing, and I'm a massive advocate of financial advice. I think as a customer, you'll get a much better outcome by dealing with a proper advisor. If you try and do it yourself, you know, it's going to be a mixed bag of outcomes, really. But the world that we live in is, of course, there's a lot of distribution that takes place through non-advice. So that really is where I do worry about all of this. Is does it go far enough? You know, it's good to see trust journeys with no signatures and you know, nice and simple and slick in terms of the mechanism of it. But you know, does a customer understand what a trust even is? You know, do they have on hand a set of additional trustees that they can name, because they need to name them at that point in time when they do the application? You know, are they going to be able to explain the roles and the responsibilities to the trustees to explain what they need to do when the time comes? I'm not so sure that that's going to happen. So are we going to really, you know, improve that trust take-up rate by making the journeys electronic, a bit more slick in terms of the button pressing? Because actually the fundamental that sits underneath it is what it's all about. And that's where I do lean towards a beneficiary nomination type of default basic outcome. That's what I've been saying for a few years. Default basic good outcome. The customer wants the money to go to that person there, and they can name it in the application. If they want something more elaborate that a trust offers, they've got some IHT planning, other bits and pieces to take care of, you know, some caveats and clauses and other things. Trust is still available. But I do worry about that non-advice space, because I think it takes up about half of the life market.
Yes.
To Ron's figures, I think it's a lot of the market. And we're not talking about just a handful of policies, it's hundreds of thousands each year.
Yeah, it was just over 50% in 2021 was non-advised level term business, which is where it roughly is. If you add a critical illness rider to it, the percentage of non-advised goes down to roughly 25%. Then it's slightly different in the mortgage sector for DTAs, presumably because there's a mortgage advisor there who's probably doing the protection anyway. But yeah, it's just over 50% of level term. And we'll be publishing this year's or 22's figures around about late May, when we're still compiling them. But quite what will happen there, I don't know. There's wider issues around consumer duty, and I think this is an important one in the non-advised space as well.
So you feel you can, back to Vincent, sorry, the journey can be as simple as you like, but if they haven't got the information as to what the journey is, it's not going to actually improve outcomes.
No, I don't think it will. I think history is, I mean, I've been in this industry about, well, just under 30 years now. And, you know, we've been talking about the same thing for a while. And I guess in that period of time that I've sort of, you know, had my career in this, in financial services, you know, I guess back in the 90s, trust forms were paper deeds with witness signatures and trustee signatures. And, you know, that if you think about the facilitation of that, you know, it's just a pain, because it's got to be posted to different people if they're not all in the same place. Yeah, that bit has definitely improved, because we're in a place now where a lot of the providers could do it slickly and electronically, point of sale, no signatures. That's great. But as we've talked about for how many minutes, 50 minutes or so, there is layers of complexity and consideration with setting these trusts up. You know, you don't want to get it wrong. And I think the reason why there's lots of advisors on this meeting today is because it's always one of those areas where there's lots of educational elements where we want to get better. You think from a customer's point of view, without any advice, without any steer, how are they going to get it right? It doesn't make sense to me. I think they need an advisor, but in the absence of an advisor, it'd be great to have something that gives them that default basic outcome. I want the money to go to that person, and I can articulate that in the application form. Done.
Exactly, and that is what beneficiary nomination does. It gives you that option.
Yes.
Yeah.
And it's by default it leads you to it because it's in the application. In other words, you don't as a customer with that route, you don't as a customer need to be educated in the sense that, well, you are funneled down that route. You don't have to know to opt for that route because it's presented to you as part of the application.
No, exactly. You've all kind of noted about non-advisory firms. This question's a bit chunky, so bear with me. Recently, Ruth noted that while protection specialists will look to take concerns about vulnerability, direction of benefit, employability or liability changes on board for new applications and reviews, there is still around 50% of level term policies sold on a non-advised basis where these issues are mostly not being addressed. Given that non-advisory firms can't advise on policies, what can be done to protect these consumers? If we start with Ruth, considering it was your point.
Well, yes, actually, as I reflect on what we've just covered, I think we've probably spoken to that point, haven't we? Yeah. Because we've talked about the difficulty of people who don't have the benefit of an advisor. They need to be led into a situation that is part of the proposition that they are signing up to. So in my head, it's a little bit, if you would like to think of a sort of an analogy here, to me, it's like, would you buy a car without a steering wheel? It seems really odd. What is a car? It's a vehicle to get you to a certain destination, basically, not a random place. And it's absolutely bonkers, of course, to think that you would find yourself in a position where you were buying that vehicle, but you needed to know to ask for a steering wheel as an optional extra. Of course, you know that's not a viable proposition. And similarly, with a life policy, it's what is it? It's a vehicle for getting money to somebody specific. And therefore, why doesn't it, baked in to what the basic product is, include that direction of ensuring, well, the person it was meant for gets it?
And I think I'd be quite interested to know what all the providers are, how they're interpreting consumer duty with this. It's the manufacturer of a product. Does it deliver? I mean, the history of the last, few decades shows us that trust take-up rate has been poor. I'm a massive advocate of trust. I think they're brilliant for what they do, but there's that layer of complexity with them. So the reality of where customers are is most people, I think we could, quite sort of confidently say most customers in a typical calendar year don't end up with their life policy written into an appropriate trust. That's just the reality of it. So what are providers doing in terms of consumer duty to avoid foreseeable harm?
Yeah, exactly. Mark, do you have any thoughts on that?
I mean, it's a great point, and it's something that all providers are going to have to consider when developing new products or actually maintaining their existing ones. So I think the one of the biggest steps that we've taken in all of this is to have a beneficiary nomination as part of our application process. It's always been there. We launched with it in September 2018. I think 2/3 of all of our applications have beneficiary nomination on them, and then about another 6 or 7% have trusts. So, we've got a huge take-up You know, the majority of our customers have their benefits directed to the people they intend. So instead of like sub 10%, we've got, you know, approaching 70, 75%. So it's a huge step forward, but it's still not 100%. Now there may be reasons why people don't want to nominate their beneficiaries at outset, but they're going to be, you know, they're going to be far and few between, but there will be a few circumstances of that. So we need to, you know, we need to give a nod to this, because there's always going to be a knowledge gap between what we know as insurers, what advisors know, and what the customer's understanding of what they should do is. So we need to ensure that we put the facilities in place in the apply process. We need to make sure we have our literature signposting correctly and pitched at the right level. And we need to remind people regularly about, you know, what they should be doing. You know, they should be, you know, if the benefits aren't nominated or written in trust, then we should be reminding people of the consequences of that. Or, you know, dependent on the financial advisor, maybe, you know, the interactions directly with the financial advisor or directly with the customer, depending on how the sale was made.
Definitely, I think that's a very valuable point about the knowledge gap. That's something that is constantly coming up with consumers not understanding everything, the advisor not being able to explain, and that's the whole point of this webinar, really, is to break down that knowledge gap.
Tabby, one of the points that came across in a recent event I did with one of the networks was precisely in this area, because we were talking about the percentage take-ups that we've been talking about today, so I won't repeat those. But one of the comments that came through and got quite a bit of support was that providers could do more in providing more basic training. Now, I know that most providers do have trust libraries that people can access. But the suggestion that was coming across was that that's okay, provided you know a little bit more than maybe you do. So what I took from that is very much that there could be a role here for providers to help a bit more with supporting the basic literature. So, you know, people in some cases actually do need to go back to the basics. Now, on this call, I guess we're going to have a whole mix of people, some who know the subject really, really well, others less so. But it just seemed to me to be quite an interesting idea and a challenge to take forward. And on the kind of wider point here, both Mark and Vince talked about existing business, and firms are going to have to review their existing business for, I guess, a year and 3 and a bit months from now for the consumer duty. And I think there really is an opportunity here for advisors who've got customers with protection policies that are not under trust to go back and review that customer's needs. And just make the changes, and it helps to build the relationship, strengthens the relationship, and it may well uncover opportunities that have just been overlooked in the past. And it's a great basis for discussion, I think.
No, definitely, and that improves outcomes as well by moving them over into trust. It's what advisors logically should be doing under the consumer duty, definitely.
Absolutely.
No, thanks for that. If we jump over to question 8. In the last month, the Consumer Duty Alliance has been established, incorporating the Financial Vulnerability Task Force and Charter. How important are trust and beneficiary nomination for vulnerable customers? And if we could start with Ron, that'd be great.
Just remembering to unmute myself. Yeah, vulnerable customers is an interesting topic, isn't it? And I think sometimes people think just about vulnerability at outset. But actually, our customers, because of the lives they lead, may well become vulnerable for many reasons, financial, health and other, throughout the duration of the long-term contracts, which are often running for anything up to 30, 40 years. So I think that when we're looking at vulnerability, we just need to accept that people's circumstances will change, and we need a proposition which reacts to those changes. So I don't really think we should be differentiated between people with vulnerabilities at outset. And we tend to do that more as an underwriting issue where it is one of those. But recognising circumstances will change, I think, just makes it even more important that we set up the ownership properly at outset. You really don't want to be trying to deal with this when somebody is in circumstances where they're just not able to cope.
No, exactly. Vince, do you have any further comments on this?
No, only real basic stuff really, which again, it's that weird situation, you know, compared to anything else that gets sold. Well, this is something where the customer themselves, you know, has got hold of something, a life policy, which only turns into money when they're dead. So of course, their kind of vulnerability issues might be over. It's actually what happens afterwards. And like Ron said, you know, things change over the course of life. Circumstances change. Things could be fine, and then things not so in the future. So reviewing policies, looking at, if we're talking about trusts, looking at what the trust says, is it going to do the right thing? You know, if the money's intended for people who themselves are vulnerable, of course, the trust is a brilliant mechanism because it can hold that money for over 100 years, if needs be. You know, it's more than you'd need. But actually, maybe some people would benefit from the money being delivered as an income as opposed to a massive lump sum, and that can be facilitated. And of course, I always lean on the sales angles with all this sort of stuff, which advisors can be right in the middle of all of that. It's a bit being able to spot what the outcomes customers need, really. Inevitably, these are long-term projects. You know, life policy is usually a long-term affair, so it's keeping in touch, making sure that everything is still fit for purpose, and keeping an eye on where things need to be. Very often, changes need to be applied. Yeah,
I agree. It's about keeping that fit for purpose, as you said. Mark, do you have any thoughts on this?
It's just really a recap of what Ron and Vincent have really said.
That's fair. The last question, we'll jump over to question 10 just because question 9 is more or less question 8, but a little bit more specific. Considering the consumer beneficial nomination specifically launched industry-wide, if we could start with Ruth on this, please.
Well, I've got a vested interest here in saying yes.
Yeah.
As the owner and offerer of beneficiary nomination to insurers. But I do hope that what we've heard today, aside from the fact that this is my main reason for still working, is to try and get this delivered in the marketplace. I hope that ignoring all that self-interest, it's apparent today that really one way or another, it's essential under the consumer duty that the direction of benefits problem is solved, and the statistics themselves prove by the low take up that trusts, although brilliant in some ways, are not that solution for the vast majority, and therefore my big answer is yes.
I remember a situation for myself a few years ago. I joined a company and they happened to have a death in service scheme. So I was part of that death in service scheme, and they sent me a bit of paper in the post, and it said, who are your nominated beneficiaries? I put the wife, 100%, and I sent it back. My challenge really to the industry is, can't we have something like that for life insurance policies? Something that simple, where we just nominate who, because of course there's all the trust processes really do work. We've got so many years of experience to prove that they do work when they happen, when they're actually used. I would go back to basic default good outcome. I would agree with Ruth. I think, yes, I think we should have that. I think it's silly that we don't.
Mark, what's your thought? I mean, coming from Guardian, who already has it in place, but
so we were the first company to bring beneficiary nomination to the market in September 2018. We've had a great take up. You know, it's turned the problem. Well, you're going from an average of 10% of cases where you know the money's going to reach the right hands at the right time. 75%. I'm an advocate. I'm a huge advocate of it. But not only that, if you use beneficiary nomination at outset, and then all of a sudden life becomes really complicated. So day one would be, look, I just want to leave my money to my partner. Simple. Somewhere down the line, life might get a bit complex, and I might, a letter of wishes, situation, which we covered earlier on, might suit me better. And that's okay, because what you can do is you can effectively replace beneficiary nomination with a trust later on if you need to. It gives you all of the flexibility that you need. So you can start off with beneficiary nomination on day one. If life gets complicated, replace it with a trust. So my recommendation is to any provider, put beneficiary nomination in your journey. Give the clients that extra flexibility.
And that's something that we've spoken about a lot in this webinar, is that flexibility for the customer to be able to make a life policy what they want it to be. And surely that's a major element of a good outcome, because you've got to give them those options. Ron, what's your opinion on it going industry-wide?
My simple view is that 100% of policies should have ownership sorted. And I know there will always be cases where trusts will be used and the advisor will prefer to do so, and that's fine. I think the beneficiary nomination has potential to do so much more, and it's a real opportunity. And we've talked about non-advised business. And for many years the industry people have been predicting the demise of the advisor. I don't really see the demise of the advisor anytime soon. I think good quality advisors will really thrive, and getting things like this done properly, I think, will be a really positive thing, and it's a great differentiator. But I do think in the non-advised world, in particular, there's a need to act fairly quickly. So if they're not looking at policy ownership, and beneficiary nomination seems to me to be the place to start, then they could have difficulties further down the line when they're having to explain why they've done nothing to put this in place. It's going to be a step change, I guess, for some firms. And that's no bad thing, because a step change that results in improved quality has to be good for the industry's reputation. It has to be good for that firm. So, I see a really strong place for beneficiary nomination alongside trust alongside the other trust approach and life of another as well.
No, definitely.
A big fan.
It seems we're all big fans here. All right, well, that's the last question of the webinar. We've still got another 20 minutes and there's a load of questions in chat. So I'm just going to quickly read through what we've got, and then I'll open them up to anyone, so anyone can just jump in and speak. What have we got? We've got quite a few about letter of wishes. Would a letter of wishes be sufficient if saying the name of the partner is living under the same roof?
I think it needs to be. Yeah, it needs to be named. The person would be named with their actual name. I think that's how it works. Unless I'm wrong, Ruth, Ron, Mark.
Yeah, I would prefer if people do say the name, obviously, and then take the trouble to change it if life changes and that's necessary. But theoretically, that would work. It's you've got similar rules apply in old trust cases, which show that does work. But the reason I'm not so keen on it is it just adds a little bit of room for argument, and for somebody who's got a shall we say a mixed love life, that could lead to argument. And I think of a friend of mine actually who for a long time her partner, sometimes they were married, sometimes not. But even in the not stage, they were partners together. But the reason why they stopped being married was it was a little bit of a complex relationship, and therefore often he was not living under the same roof as her. Sometimes he was, sometimes he wasn't. So in that situation, would that count? Very hard to answer that. They each owned their own property, and sometimes they lived together in one of them. So it's that sort of example that would make me go with Vincent's approach on that, is that, oh, well, yeah, theoretically it can work, but it's safer to be more precise.
No, definitely.
It usually says on the trust form, any person named to the trustees in writing. So that's where that, I guess, there's that grey area. Does a class or the specific detail of that person? If in doubt, I'd go with the name.
Yes, that's a very excellent point as well.
Next one, we've already touched on this, but just to reiterate, could the beneficiary be changed in case of changing circumstances?
Yeah, absolutely. Yeah. That's the whole, with a discretionary trust, of course, you know, if it's absolute, their trust, you've locked them down. You can't change them. But if it's a discretionary trust, that's the whole point, because people want that level of flexibility. And of course, if you've got, you know, maybe a simple example would be, I want all the money to go to my 2 children, but actually when I die, I've got 4 children. You want the flexibility to change that? Well, yeah, you do. So that's what a discretionary trust does. You know, letter of wishes can provide a little bit of extra clarity about exactly the circumstances and who should benefit.
And the same with the beneficiary nomination, of course, as we've discussed. You've got the flexibility to update that, but you've got to remember to tell the insurer.
Yes, exactly. You've got to tell them the circumstances. They can't mind read. Next one is, can a trust be revoked and rewritten during the life of a policy?
You could cancel the life policy, I guess.
The only exit plan that you've got from that, once you've done it, you've transferred it over into the trust. The trust effectively owns the people carrying that ownership of the trustees. So once it's in the trust, it's in the trust for good. So no, none of the life insurance trusts on the market are revocable, and that's because it needs to be that way to be inheritance tax effective for avoiding. Because if you've got a way of you can just get it back, then as far as HMRC are concerned, well, you haven't fully given the thing away, so it's still in your estate. We'll still have that for inheritance tax. Thank you very much. The only exit route is that occasionally there are some trust wordings out there that allow within the trust that the trustee powers, things they're allowed to do under the terms of the trust, is to set up a new trust with certain limitations carrying over. So the new trust would not be allowed to give the money back to the original settlor and policy holder, but it would allow for a new scenario that maybe the a usual trust doesn't allow for. So it could give a route for expanding the options for how the trustees use the money. But the short answer is no, can't be revoked.
Right.
So please do get it right at the start. I know I've noticed sometimes trusts come in, and I had a query come to me recently where 6 months later or something, somebody had changed their mind about whether they wanted to keep the terminal illness benefit under the trust or give it away. Well, that's unfortunate, because you've already signed a trust that says one thing, and that trust, the rules of that trust and what you've said applies.
Exactly. That's why it's so important that we do these kind of educational webinars, so people know exactly what they are doing.
I think it's also important with the point that,
sorry.
Sorry, Tabitha, with the point that Ruth just said there, it's also important, if that's a consideration, what Ruth just said there was terminal illness benefit. Well, the world of trust is polarized on that score. Some of them allow you to retain it for yourself because it is a life insurance benefit. So if you put life insurance into a trust, you've given it away. So there's some providers that allow you to retain it. It's a little tick box on the form. Other providers don't even give you the option. So if that is a consideration in the advice to the customer, you got to think carefully about where you actually, which life insurance company you recommend if you're using their trust form.
That's another very
It shows there's layers of this.
Yeah,
you need to note about beneficiary nomination that does it automatically keeps terminal illness, critical illness. It's all kept from you. It only deals with what happens with payments after death. If you start as a terminal illness payment and the person unfortunately dies quickly, such that the proceeds are still not paid until death, then the nomination would still apply. So it's proceeds after death. Beneficiary nomination deals with that, but it does not give you the option to say, oh, we want to give away the terminal illness benefit as well, because basically it's designed to be a simple solution that's quick to deliver at application and will suit most people. After all, you could actually just not claim the TI, and who would know? So it works that way, but it can be, if you're an advisor who faces a situation where inheritance tax planning really is important, that's one thing to realise, is that actually you might want a trust in that scenario if they need to ensure that there's no doubt the terminal illness benefit can't get caught in the inheritance tax trap, because obviously if it pays out, then it's in the person's estate just before death, which is maybe the opposite of what they wanted.
No, that's very important actually. Yeah. We've got a couple more questions about trustees this time around. If the trustees are the owner of the trust, can they not make changes?
What changes are we talking about?
They're not specific on which changes.
If the trustees are the owners of the trust, can they not make changes?
I think it depends at what stage. So whilst the life assured's alive, the life assured is the settler and also a trustee, and they have the power to change the beneficiaries while they're alive. They also have the ability to retire and appoint new trustees, subject to following a process. Once that person's died, the additional trustees then have the power to administer the trust based on the trust clauses that are in place, which usually means actually paying out in accordance with the life assured's wishes, but they can vary from paying the nominated beneficiaries to paying potential beneficiaries if they choose. So yes, they do have the power to make some changes, but I would always defer to Ruth on these things, and I don't know if Ruth has anything further to add.
Like yourself, I'm not entirely clear what scenario the questioner is considering, but I think my answer would be pretty much the same as you, Mark.
It was linked to that revoking and changing question from before.
I was just going to say, Tabitha, the trustees don't have an awful lot to do, because like Mark said, one of those trustees, the most important one, is usually the customer. I think most life companies make the settler, the policy owner, the settler, and a trustee, the first trustee. So all the other trustees are additional trustees. So their work kicks in usually when a claim happens. But the one scenario that does spring to mind is usually if there's some kind of guaranteed insurability option or something to actually change the plan. Of course, the plan owners with some life offices might need to sign something to allow that to happen. So they might have to have, because the ownership has been transferred. So you might have something like that.
He clarified the question was about the revoking and changing during the journey, which we spoke about previously. We've got one about pensions. Can a pension that pays a lump sum on death also pay out to the life trust or not?
Yeah, on this one, Tabby, normally it would be the case that the employer will be providing a death in service benefit. Now, that can either be under the pensions legislation, a registered pension scheme, and there's about 7.5 million people, I think, covered under those. And the alternative to that is what's called an accepted group life policy. Now, both of them use discretionary trusts. And as we've been talking about earlier, they do enable the proceeds to be paid free of IHT, and in most cases, pretty quickly, with the usual caveat about the complicated lives and the discretion that trustees face. I think they would generally be seen as entirely separate. Where this is going from 2023 onwards, I'm not sure, because we've seen the abolition of the lifetime allowance 5 days ago now, and that is likely to see us swing back towards using registered pension schemes, because you can include people who've opted out because of lifetime allowance issues. The other approach of using a pure life assurance policy has a few restrictions on it, but generally I think these would be treated very separately from any pension benefits. I'm not an expert on pension trusts other than that, I have to say. So residual lump sums from DC pensions and things like that. If others on the panel here can help, I'd be grateful, because I wouldn't pretend to have any detailed knowledge of that.
Anyone a pension expert? No. I think that's as far as we can go with that question, unfortunately. Let me check. If a life policy is written in trust, can the settler stroke life assured cancel the policy?
Yes.
Oh, sorry. Yes, they can.
Whilst the life policies in force, the settler generally just controls the policy. They can generally do increases, decreases, remove benefits, cancel the plan. I mean, it will vary by insurer. So like certainly the Guardian Trust, the life assured, person who set up the trust calls all of the shots, uninhibited by anybody else whilst they're alive. It's only after they die that the additional trustees are required to act.
As Mark says, some insurers still, I believe, do take a different line and take the sort of view that, well, actually the whole policy, as regards everything, is now owned by all the trustees, and sometimes will require the signatures of the other trustees to authorise whatever option it might be. So that's something that does vary, and if you're concerned about it, it's worth finding out from the insurer.
No, that's a good point, actually.
I suppose you might come across some old unit-linked policies with cash values, and some customers may want to take a withdrawal of cash from those plans, but the additional trustees would have to agree to that happening, and the life assured cannot have that money. It has to go to the beneficiaries. So yeah, so it varies from provider to provider, you know, as
I think that's the final question.
There was Tabitha. There was one question I just saw in there that from Julia. Julie, you said, "Can a trustee be changed under a flexible trust?" I just want to pick that one out, because the answer is yes, you can. But again, when you peel back the onion layers, actually this can be quite a job with some providers. You know, if you think about the journey to actually write a life policy into trust, quite often we can do it electronically, online, no signatures, great. But very often when you actually want to retire a trustee, you need a form to do that. And it usually needs wet signatures, and it usually needs witnesses and things like that. So it's probably, as a bit of homework from beyond today, have a look at those deed of appointments to retire or appoint additional trustees, because that will show you the experience of what you're going to have to go through to actually make that happen. And I think that question, you know, is quite a good question, because can we change the trustees? Yes, you can. But let's look at how you do that. What needs to happen? Sometimes there's quite a bit of work.
Brilliant, thanks, Vincent. I'm noticing one or two other questions that are in the thread that I'm aware we've really come to the end of the time now, and I'd be happy, and maybe the others would help me out here, but we could pick up any that haven't been dealt with as part of the sending out of the link later, if that would suit, to make sure there's some. There's a juicy one right in front of my eyeballs. I'm thinking, oh, that's quite tricky. Maybe we should get that.
Yeah, there's a
afterwards.
scenario there.
I
We've
will
got
pull the list of questions after the end of the session and send them round, get Tabby to send them round to everyone, and then we can put some of the answers maybe in the email that we send to everybody at the end of the session. Does that suit?
That's great.
Brilliant. Okay, well, Tabby, thank you so much as always for leading that panel, and Mark, Vincent, Ruth, Ron, thank you so much. I hope this has been a really useful session for everyone, and a big thank you especially to Guardian, who sponsored this session. So yeah, thank you very much. Mark, is there anywhere specific that anyone can go to learn about Guardian should they wish to learn more about this?
They can come to our Guardian 1821 website, or they could get in contact with one of our business development managers.
Brilliant. Well, please do that. As you've heard from this session, Guardian are the people that know when it comes to these things.
Yeah. If anybody's interested in, because we know some people would like their knowledge, their base knowledge raised on trust, they can always get in contact with one of our business development managers, and we'd be happy to do a session for them.